Welcome back to the channel, everyone. Today, we're diving into The Little Book of Common Sense Investing by John C. Bogle, the legend who founded Vanguard and basically invented index fund investing. This book is all about simplicity and letting your money work for you. No need for any get-rich-quick schemes here. We're talking about a strategy that's been proven over decades to deliver solid returns and help people achieve financial freedom. Let's get started. All right, let's kick things off with the fundamental principle of Bogle's investment philosophy investing in the entire stock market. Picking individual stocks, even if you do your research, is a lot like trying to time the market. It's incredibly unpredictable. Instead of trying to outsmart the market, Bogle says, why not just own a piece of it? That's where index funds come in. These funds track a specific market index, like the S&P 500, which is made up of 500 of the largest U.S. companies. This gives you instant diversification and helps manage risk. When you invest in the entire market, you're betting on the overall growth of the economy, and historically, the market has always gone up over the long term. With index funds, you're not gambling on individual companies. You're investing in the entire market's potential. It's a much more reliable way to build wealth over time. Let's talk about fees. Fees can significantly impact your investment returns over time, and it's crucial to understand how they work. When it comes to investing, every dollar you save in fees is a dollar that stays in your pocket and compounds over time. This compounding effect can make a substantial difference in your long-term wealth. That's why Bogle is such a huge advocate for low-cost index funds. He believed that minimizing costs is one of the most effective ways to maximize your investment returns. Actively managed funds are run by fund managers who try to beat the market by picking and choosing stocks. But these funds come with hefty fees. These fees can eat into your returns, making it harder to achieve your financial goals. Studies have shown that the vast majority of actively managed funds fail to beat the market over the long term. This means that investors are often paying higher fees for subpar performance. Now let's compare that to index funds. These funds are designed to replicate the performance of a specific market index, providing broad market exposure at a fraction of the cost. These funds are designed to simply track a specific market index like the S&P 500. By doing so, they eliminate the need for expensive research and active management. They just follow the index, which keeps their operating costs super low. This cost efficiency is passed on to investors in the form of lower fees. We're talking about expense ratios as low as 0.03% per year for some index funds, compared to 1% or even 2% for actively managed funds. This difference can have a huge impact on your investment returns over time. Over time, those seemingly small percentages can add up to a mountain of money lost to fees. This is why it's so important to be mindful of the costs associated with your investments. Keeping your costs low allows your investments to grow faster and work harder for you. The less you pay in fees, the more you keep for yourself. So when choosing your investments, remember Bogle's golden rule: keep it simple, keep it low cost, and let compounding work its magic. By doing so, you can achieve your financial goals more efficiently and effectively. Let's talk about one of the biggest mistakes investors make: trying to time the market. No one can predict the market with any consistent accuracy, not even the so-called experts. The problem with market timing is that it's based on speculation and emotion, not on a sound investment strategy. When you try to time the market, you're essentially gambling, hoping to get lucky and make a quick buck. Instead of trying to time the market, Bogle advocates for a much simpler and more effective approach: time in the market. This means investing consistently over time, regardless of what the market is doing at any given moment. By staying invested, you ride out the inevitable ups and downs and benefit from the overall growth of the market. Staying invested allows you to relax, knowing that you're participating in the market's growth potential over the long haul. Alright, let's talk about everyone's favorite topic: compound interest. It's a concept that can truly transform your financial future if you understand and utilize it correctly. This is where the magic really happens. Compound interest is the secret sauce that can turn modest savings into substantial wealth over time. Compound interest is essentially interest earned on interest. It means that the interest you earn each period is added to your principal, so the balance doesn't just grow, it grows at an accelerating rate. It's like a snowball effect for your money. As the snowball rolls down the hill, it picks up more snow, growing larger and larger. As your investments grow, the interest they earn is reinvested, and then that interest starts earning interest itself. This cycle continues, creating a powerful growth engine, and then that interest starts earning interest itself. This compounding effect can lead to exponential growth over time. Over time, even small amounts of money can grow exponentially. The key is to start early and be consistent with your investments. Let's say you invest $10,000 today, and it earns an average annual return of 7%. This might not seem like a lot at first, but the results over time are astonishing. And it earns an average annual return of 7%. After 30 years, your initial $10,000 investment would have grown to over $76,000. After 30 years, your initial $10,000 investment would have grown to over $76,000. That's the power of compounding. It's like planting a tree and watching it grow into a forest. That's the power of compounding. The longer you let your money compound, the more dramatic the results. The longer you let your money compound, the more dramatic the results. Time is your best friend when it comes to investing, the more dramatic the results. This is why starting early is so important when it comes to investing. The earlier you start, the more time your money has to grow. This is why starting early is so important when it comes to investing. Even if you can only invest a small amount each month, it's crucial to get started as soon as possible. Even if you can only invest a small amount each month, it's crucial to get started as soon as possible. The sooner you begin, the more you can take advantage of compound interest. It's crucial to get started as soon as possible. Remember, compound interest is like a snowball rolling down a hill. Remember, compound interest is like a snowball rolling down a hill. The longer it rolls, the bigger it gets. So start now and let your money grow. The longer it rolls, the bigger it gets. The earlier you start, the more significant your financial growth will be. Don't wait, start investing today. Let's talk about something that can derail even the most well-thought-out investment plan market noise. This noise comes from various sources like news channels, social media, and even well-meaning friends and family. The problem with all this noise is that it often creates fear and uncertainty, which can lead to emotional decision-making. Emotional decisions are rarely good for your financial health. When the market is booming, everyone's suddenly a financial genius. It's easy to get caught up in the euphoria and make impulsive investments. Then, inevitably, the market takes a dip and panic sets in. People start to question their decisions and consider pulling out their investments. But here's the thing, market fluctuations are completely normal. They are part of the natural cycle of the market, and they happen all the time. They're part of the natural cycle of the market. Understanding this can help you stay calm during turbulent times. Instead of getting caught up in the noise, Bogle advises investors to tune it out and focus on the long term. This means ignoring short-term market movements and staying committed to your investment strategy. One of the best ways to stay the course is to have a solid investment plan and stick to it. This plan should be based on your financial goals and risk tolerance. This means determining your risk tolerance, which is your ability to endure market volatility without losing sleep. Choosing investments that align with your goals, and ensuring that your portfolio is diversified to spread out risk. And rebalancing your portfolio periodically to ensure you're on track. This helps in maintaining the desired level of risk and return. Keeping your long-term goals in mind can help you weather the inevitable market storms and avoid making rash decisions based on fear or panic. Remember, patience and discipline are key to successful investing. Let's talk about the difference between speculation and investing. Speculation is essentially gambling. It's trying to make a quick buck by betting on short-term price movements. Think day trading or jumping on the latest meme stock bandwagon. Investing, on the other hand, is about building wealth gradually over time by putting your money into assets that have the potential to generate long-term returns. The key difference is that investing is focused on the long term, and it's based on a solid understanding of the underlying assets you're putting your money into. Bogle was a huge advocate for long-term investing. He believed that the best way to build wealth was to invest in a diversified portfolio of low-cost index funds and hold them for the long haul. Investing is about making smart, calculated decisions with your money and letting time work its magic. So, who should read The Little Book of Common Sense Investing? If you're new to investing and feeling overwhelmed by all the options, this book is your roadmap to getting started the right way. If you're tired of high fees eating into your returns, or frustrated with the performance of actively managed funds, Bogle's index fund strategy offers a refreshing and effective alternative. In conclusion, The Little Book of Common Sense Investing is a must-read for anyone looking to grow their wealth in a smart, low-risk way. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon for more insightful content.